You've been lied to about candlestick patterns. What you learn is only half the story. Candlesticks alone don't show the institutions. Even Munahisa Homa, the legendary trader who invented candlestick charts, tracks something else no one talks about. If you're a struggling price action trader, frustrated by fake outs, or puzzled why some zones hold while others fail, this video is for you. What you'll learn today will change your trading career forever. You need to learn volume analysis and order flow. I'll show you exactly how price moves from one candle to the next and how to spot the hidden institutions that you can't see with candlesticks alone. This is the same system that have helped me develop 5- and 6-figure traders. By the end of this video, you'll know why some breakouts succeed or fail in real time and how to avoid getting trapped by false signals. If you want to download a PDF that will help you follow along, click the link in the description. The first very important point that you have to accept is this. We can have two bullish candles that look exactly the same. One can be a weak candle and the other can be strong. Not all candles that look the same are the same. You've been told that every bullish candle is strong, but that's a lie. One candle can have 3,000 shares traded and the other candle can have 300,000 shares traded. Here's the problem that we're all trying to solve. We have 4 scenarios here. The first scenario is we have a key level and we want to enter a potential reversal from that level, or we want to enter a breakout from that level. So as price approaches the level here, sometimes price approaches it and reverses before touching the level. That happens at times. Another scenario is price approaches the level, it goes within our level, and then it actually responds as we determine that it may. Sometimes we have price go through the level and then turn around aggressively. This could be a time where there's a fake out, or we may be able to enter that false breakout to the short side, or we're looking for price to come through that level and join the breakout. Now, price alone will give us these scenarios. In these 4 scenarios, we try to use price action candles, but they can be misleading. Here's where volume analysis and order flow come in. Now, why is this important? Just imagine you open up your chart and price is in a range and you're looking to buy this breakout. Price pushes up, you enter, pulls back, pushes up, and you're still holding, and then goes against you and takes your stop. Now, the analogy here is that it's 2 people pushing a car up a hill. So if you have 2 people that are pushing a car up a hill, these 2 people may be struggling to get the car up the hill. And depending on the strength of those people, how many people are behind the move, you may see the car moving up the hill, but it doesn't mean that it has strength and a lot of people behind the move. So what you see here, as price moves up and you see these big green candles being created, if you had the ability to see whether or not there was a lot of traders behind it, there was big or small traders, what types of traders are behind that move, then it will give you conviction or help you avoid holding until price hits your stop loss. Now, on the flip side, we can have a car coming up the hill that is being pulled by a tank, that is being pulled by a tow truck. Because of the strength of this tank, it's likely that this car is going to go up the hill without people being fatigued, and it's likely to get up that hill. So the analogy, the connection here is when you look at this move here, if we were to enter that same move as price starts to reject here, even if you just traded this move before, you see the move goes up, then you start to see some rejection. You may get nervous if all you have is price action. But if you can see volume and order flow, then as this rejection is happening, you may see that buyers with strength are still stepping up to take this move higher and higher. And once you see the types of buyers that are behind the move, you see that more volume is getting behind the move, more stronger or larger shares are being traded, then that can give you the conviction that you need in order to stay in that trade until it hits your target, or to add to the trade to start to scale in. If you agree, continue the video, because I'm going to show you how to incorporate volume analysis and order flow in your trading in order to avoid fake outs, time reversals, and be confident when price breaks out. Let's dive deeper into volume. Every chart has volume bars as a standard indicator. I'm going to remove the price action, but look at how momentum blasts up and look at volume here. But let's talk about volume. We'll stay with the car analogy. And at the open, where we saw the big price spike and rally momentum, it's either two cases. One, you have a bunch of buyers getting behind price. So it's like a bunch of people pushing that car up. Okay. So on the opening range breakout, if you are to buy and you are relying on price action alone, you're missing out on information that is available to you unless you trade Forex. So this is a key ingredient to help you trade stronger, more confident. Another example is if you have a large buyer. So this guy is like the Hulk compared to these, and he is going to push that car up the hill, and that could be representative of the constant volume that you see here. So when we go back to this example, this price is moving up aggressively, and you have an institutional buyer that can be supporting that move. And if you can see that, that will help you trade more confident, scale in and add to your positions. Now, you may ask, how do I know if it's a bunch of small retail traders versus an institution? We'll understand that by order flow. But let's continue our conversation on volume. So as the day goes by, we move into this scenario where you start to see more red and green. And this can be representative of now more sellers coming in here on the other side to go against the buyers, and less buyers here trading. All right. As the day goes on, we start to see more scenarios. And then as we approach here, we see more of the red bars. There can be more sellers coming in here to lend a help, or that institutional buyer that was there in the beginning can be coming now to unload shares here. So that could also be the case when we look at what's happening here. We see the spike in volume here. So if you haven't been using volume and price, there's a narrative that volume communicates. Volume communicates strength, interest, and validates price. And then as the day goes on, we'll start to see that the volume is dying out, and we may have these little spikes here and there. This represents just a few buyers that are coming and buying a few shares, but this isn't strong momentum. There isn't strong momentum, strong interest that is sustainable. And then lastly, as volume dies out here, we start to see this is representative of people withdrawing, interest withdrawing. And this is where a lot of traders get chopped out because there's actually no real volume that they're looking to support their price action trading isn't there. And this is where we find a lot of price action noise. So we go back and look at price action. Look, at the time we had sellers coming in here when that volume rose, but compared to the volume on this side, it's fairly low. As volume starts to wither, we have more chop. And I used to open up my chart, draw lines on the chart, and look for little bullish engulfing candles, little bearish engulfing candles, and justify trading. And I would sit there. I had a day where I win, but then the majority of these days are losing days. We want to be trading when there's elevated volume because there's more interest, and it's likely that we will have price action with stronger follow through that will allow us to take one side and hold or scale in. So in summary, we want to see that volume validates price. So rising prices, rising volume validates our buy thesis. If we have falling prices and rising volume on the sell side, this is a validation for the sell. Okay, so volume analysis will help us in these scenarios. So on the way up, for the scenario number one, the volume bars may be increasing and start to decrease as price approaches the level. And when the reversal happens, typically we may see the volume here increase higher than the volume on the rally. So that's what we may still be waiting for price to touch the level. But if volume increases here and more sellers start to come in on this pullback move, then we no longer have to guess and wait because volume confirms it. Okay. Now, this scenario we can also benefit from the volume conversation, because again, typically we're going to see volume rising as we pull up, and then we can see a huge volume spike at the turn, and then we may see price fail to break out, and then volume is increasing here on the way back. So that's how volume can help us there. So what about scenario number 3? And I'll show you examples on the chart shortly. So as price pulls out here, typically the volume is going to be weak. So volume may be increasing here, and then on the breakout, we may not really see a increase of volume. This is typically going to be a sign that the buyers are not coming in here. So normally when price breaks the level, the volume should increase significantly. But if it doesn't, and then in turn we have volume increase on the sell side, then that right there is typically a sign that price is going to fail. So when price is breaking out, we see less volume than before. That's typically a sign for the fake out. And in this case, as volume is increasing and it remains stable while we're in the level, and as it breaks out, we want to see increased volume on the breakout. And that typically is a sign that buyers are getting in and they're supporting the move. Now, we can go into greater detail here, but I'm going to pause the video and say, if you want to follow along with this video, click the link in the description to grab the free PDF. Now, part 2 of this is going to go into a deeper dive, and we're going to start to talk about volume delta. We're trying to make our way towards order flow, which is at the end of the video, but I'm trying to walk you step by step. Now, volume is great, but the reason why people use order flow is because you can see the imbalances between buyers and sellers. The reason why order flow is better than the normal volume, and that's where we want to go. That's what the pros use. That's what my students have used to make 5 and 6 figures. The reason why we want to go here is because the normal volume bars can be misleading. These volume bars only show us the total amount of volume traded. It doesn't show us how much sell volume happened versus how much buying volume happened. Okay, and that's important. And let me explain that a little bit more. Every exchange tags one side as the aggressor. It's the order that crosses the spread. I'll get into that later. But you have something called aggressive traders and passive traders. The passive side is where institutions hide. The aggressive side also gives us a story. And that's what we see when it comes to price action candles. So the aggressive traders, we say that they are the sell volume, the aggressive sellers, and the bid side trades would be our aggressive sells. So let's call that our sell volume. And the ask side trades are our buying volume. Again, I'll do another video to break this down in greater detail. So what do we want to see in terms of volume? We want to see if the sell volume was greater or the buying volume was greater. And that's referred to as delta. If delta is greater than 0, then the buyers are more aggressive. If delta is less than 0, then the sellers are more aggressive. And how is that done? How is that calculated? That's calculated by taking the buy volume, subtracting it from the sell volume, and that will give us the delta. So let's say that you had 800 shares traded on the ask minus 500 shares traded on the bid, and that will give us positive 300. That means that the buyers were stronger than the sellers. We have another scenario where we have 500 shares traded on the ask and 1,000 shares traded on the bid, and that will give us a negative 500 delta, meaning that the sellers were more aggressive. So what does this all mean? This means that a red candle like this one can print on positive delta, meaning that even though price went down, the buyers were more aggressive than the sellers. And this is the key right here, because if price is up plus buying aggression, this is confluence. And this is where the confidence comes in to hold in this scenario. We also can have negative delta in this scenario where price is printing green, but we can have negative delta, meaning that the sellers were more aggressive, but price held positive. How is that the case? That can be the case because of the passive traders. So you have two types of orders, as I mentioned: passive buyers, passive sellers, aggressive buyers, aggressive sellers. The quickest analogy that I can make, and we're diving deeper, but this will help you. You have aggressive trading and passive trading. The passive buyers are like a sponge, and they sit there. They don't move price at all. The aggressive traders move price. So let's say you have an aggressive seller, and the aggressive sellers are like pouring water. They're trying to get rid of their contracts, trying to get rid of their shares. They're selling to the buyers that are passive, that have limit orders. So the aggressive sellers are pouring their contracts, and this buyer is sitting there, let's say at $5, and they aren't doing anything. They're just sitting there with a limit order, and they are soaking up all of the shares. So in this example that I gave you here, there may be a passive buyer sitting there, and these wicks that you see may be aggressive sellers. So during this time, we may have had, let's say, negative 15K delta, meaning that the sellers were more aggressive. But we had a buyer sitting there, a passive buyer, that soaked up with that sponge. They soaked up those 15,000 shares. And then the aggressive buyers came back in and overpowered the sellers. This is powerful, because as you see these rejections, you may want to get out. If you see aggressive selling and there's more sellers there, but price isn't moving, then that can be an indication that there's a big buyer there that's holding price up and defending the move. Or on the flip side, that's divergence. And this, you could have convergence as well. We're here and there's a tug of war going, right? Maybe delta is around 0, meaning that there's an equal amount. There's 800 aggressive buy orders and 800 aggressive sell orders. So there's delta here. Doesn't mean you need to get out, but it means that there are buyers and sellers having a tug of war. And you can't see this from here, the volume chart. Now, as price starts to push through, then you may start to see that the buyers are overwhelming the sellers. Price action and volume, looking at volume this way, will give you confidence and help you with those scenarios that I communicated. So let's go back to the scenarios. Scenario 1, as price is turning, we may see the buyers are very aggressive at one point, but we may see an overwhelming amount of selling aggression, delta, to when this price is coming down here. And that we don't need to wait for the level to be hit, because the selling aggression is proportionately greater. Here, as price pushes through this level, if buying aggression here on number 3 isn't relatively greater, then that also can communicate that the sellers are still present and the buyers are not strong enough to take price higher. So what that may look like, if we were to use on each volume bar, we show relative as price is going through. Let's say this is one volume bar, but I'm going to show how much of it is green versus red, signifying how many buyers versus sellers. So as price is going higher, we may see, an equal amount of buying and selling happening and being printed. Versus here, as price breaks through on number 4, we may see an overwhelming amount of buying volume versus a small amount of selling volume, right? As each candle is being printed, the buying volume, even there are going to be some sellers. People are going to be selling, but aggressive buying is significantly greater in this scenario as price is breaking out. You get used to reading both. Now let's jump into an order flow tool that makes it easier. Now, I'd say for everyone, especially if you're trading stocks, to read the tape in level 2. But here's a bridge to tape reading, in my opinion. And there's an indicator called the cumulative volume delta that can be used that will help you with this buying aggression versus selling aggression. Okay, so let's talk about cumulative volume delta. This has been a game changer for a lot of my students, those that have made 5 and 6 figures. This has helped them. So remember, delta is the difference between the aggressive shares that are bought or sold. So if delta is greater than 0, the buyers are in control or more aggressive. If delta is less than 0, then the sellers are more aggressive. Now, we want a way to visualize this. And that's where the cumulative volume delta indicator comes in. So here's how it works. In order to access it, you go to indicators and you type in cumulative volume delta. And this is your normal volume bar. And this is the cumulative volume delta. All right. Now, if you look at, we're going to break down this indicator. So the cumulative volume delta, it plots out delta over time. So that just like with price, you can get a sense of at any time frame, if the buyers have been in control, if the buyers are in control, or if the sellers are in control. What this will give you is a trend amongst the buyers and sellers, so you can see the flow of the buying aggression versus the sell aggression. So if price is above zero, that means that buyers have been in control. If price is below zero, that means the sellers have been in control. And then you'll see waves of control here, just like with price action. So how do you use this? Well, we use this to confirm price. So let's look at a few scenarios. Price approaches a level here. So price breaks VWAP, pushes down, and as price pulls down, we see that the sellers are more aggressive. And then price ranges a bit, and then now buying aggression comes in. And what you'll see is that as price pulls back here with the CVD, we call it cumulative volume delta. Okay. As price pulls back here, the sellers do not overwhelm the buyers. Okay. And then as price pulls through this level, you're going to see the buyers are remaining in control. So that right there gives us confirmation that this breakout here can work. Okay. Now, you may say this looks just like price action or looks similar to it. All right, so I'm going to show you an example where it doesn't look the same. And this is going to help with, as I mentioned, fake outs. Okay, so right now we have the delta price and volume delta is in confluence. So let's look at another case where it's in divergence. In this case, price blasted up with a massive bullish candle. And look at what happens though. So you have buying aggression here, it's above zero. But as price pulls back here, what do we see? We see that the selling aggression has now taken over the buying aggression. The delta is below zero. Now, what is this communicating? This is communicating that the selling pressure on this small pullback is greater than the buying pressure on this initial move higher. This is divergence. And typically when we see something like this, we may be looking for the continuation. But oftentimes this communicates that the sellers are very aggressive. There's not many buyers behind this move. And as we see, the buyers try to become aggressive here, but look, price isn't moving. So what does this communicate? Number one, sellers are more aggressive here. So we want to pause on the buying the breakout here. And then number two, the buyers start to become more aggressive here. Buyers cross over VWAP. Price isn't moving. Why isn't price moving? Price isn't moving because of the passive seller sitting there. So the buy orders are coming in here, but price isn't moving. So the buyers have now shown over this little time span to be more aggressive than the sellers, but price is not moving. If you didn't know about this, this is important. There's a passive trader here. A passive seller, this is where institutions hide. As I mentioned, they hide their intent in the passive orders. So there's a limit order here. The buyers are buying the shares, but there's a passive seller sitting there and they are selling all their shares to those buyers. And typically when you have something like this is called absorption. So even prices, even moving, is trying to move higher and the buyers became very aggressive, but there's a seller there sitting there. And that seller is likely to be a larger seller because the buyers are failing to move price. So typically the combination of selling becoming more aggressive and then the passive seller sitting there and absorbing the buyers, this right here typically is a sign that this is not going to work. And look at what happens versus our order scenario. So if you learn how to read volume delta, either using the cumulative volume delta indicator or taking a step further and reading the tape in level 2, which I believe is the best because you can't see the passive seller here, but on the level 2, you could, and we'll do that in another video. If you enjoyed this video, please click the link in the description to grab the PDF. Please like and subscribe. If you want to see a video where I do a deeper dive into level 2, watch this video.